All right, guys, how is everyone doing? This is Paul Singh, the Market Speculator with bullsonwallstreet.com. Today, we're going to talk about the big Fed decision today and how we trade around an event like this. Focused on swing trading, and although I don't talk about day trading a lot, today we'll mention it a little bit because it's a special case. So the expectation today is that the Fed is going to raise rates around 0.75%, possibly up to 1%. So this is kind of the sweet spot here, which isn't going to have a huge impact on the market. Maybe we go up some, maybe we go down some, but going forward, it probably would not cause a huge trend in either direction because that's what the market is expecting right now. And anytime, even if it's a big decision, and raising interest rates is a big decision, but anytime you get something that's expected, the market is already prepared for it. Some of it has already been priced in. We've already seen what would be expected, like banks moving. Banks have already started moving, and they usually do move well when the market when there is a raise in interest rates. So that's been expected. The market has reacted already to that. Now, the Fed doesn't always do what's expected, and world events don't always happen as we think they're going to happen. So if there is a surprise today, if rates, instead of the 0.75, if it goes around 1, or even there was a really big surprise, which is not likely, but we should always be prepared. You know, if there's a 5% chance this could happen, we need to be prepared for it. So if that were to happen, something really out of the expected, that's where we could get the big down move, especially at these extended levels. This would scare everybody, and boom, we get the big pullback. So be prepared for that slightly unlikely event here. But if it does happen, we should be ready. We know the market is probably going to pull back hard, and that we have some go-to moves for that to happen. Now, if the opposite happens, instead of 0.75, we get 0.25, we get 0.5, or maybe no raising at all. Again, these things are probably not likely, but if they do happen, that would likely have a positive effect on the market, and we could fly from here. So basically 0.75, market probably doesn't do a whole lot. You know, it could go down some, could go up some, but probably wouldn't start a huge directional move, at least going forward for, you know, weeks. But if we get lower than that, we could get a huge run in the market. If we get higher than that, we could get a huge pullback in the market. So we'll be prepared for that. Now that we know that, how do we trade around that? And the key tickers for me are going to be UVXY, SVXY, and if you want to play it a little safer, you can do the market indexes, which would be SPXU and SPXL. Now, UVXY and SVXY, they are the VIX triple leveraged ETFs. And what's going to happen here is if the market tanks, we'll likely get a huge spike in VIX, which would mean we take UVXY. And let me show you some examples here of what UVXY can do when there is a big market down move. You can see normally UVXY is in kind of a downtrend here, but we get these really big spikes when the market tanks. If we go back to 2015, at the end of summer here, we had a huge pullback in the market, and UVXY went up over 100%. And we, back in here in early 2016, we can look at SPY here. SPY had tanked at this point, tanked at this point, and these are only 8 to 13% moves, but that gets UVXY moving over 100%. So we saw that again in January, where we had the huge spike and over 100% again. And then if we were to look closer on some of these mini spikes we've had, that's when UVXY gets moving, 65 to 100. You know, here We had not quite as big of a move, but 52 to 60. And we'll see how it would play out this time. But it's a very low risk trade. So if we see today and tomorrow that the market is reacting very poorly to the Fed decision, you can automatically put this UVXY on, and we could get a spike from 18 to 25, 18 to 30, 18 to 35, depending on how badly the market were to pull back or how deeply the market were to pull back. Now, the opposite is true. Is if the market were to spike, you could go to SVXY, and you'll get these big moves to the upside. And we're ready to break to all-time highs here if the market does as well. So we could see a quick move here from 140 to 150 to 160. So if you're an aggressive trader and you like to take on a little more risk, you can play these ETFs. These are triple leverage. You could even go with the double leverage, which would be for the VIX would be VXX. So you could go with one of those. If you want to play it safer, just use the market indexes. Now, SPY is going to be a little too or less volatile, not the type of volatility we like to trade, but you could go with the triple leverage, which would be SPXU and SPXL. So this is the bullish here, SPXL, SPXU would be the bearish play, the inverse ETF. So you can go with one of those the same way we just talked about VIX, but you could use the market indexes. You're not going to get the volatility. You're not going to get the huge gains you would with VIX. Now, if you want a happy medium between these two, go with some of the big tech stocks. They'll move according to what the market is moving, but probably a little faster. So you could go with something like Google, and Google right now is right at all-time highs, so it could really explode if the market explodes. And if the market tanks, it's probably going to get hit pretty hard. You can do the same thing with Amazon, which I am in right now, with Netflix, which I also am in right now, with Facebook, which is near or at all-time highs right now. Or you could even go with something a little slower like Apple. So narrow down what you're looking at, and then as the Fed is out of the way, starting with next week, you go back to your normal trading, all of the focus list stocks, all of the sector plays, all of the momentum stocks that you've been paying attention to, you can go back to that. But for now, narrow it down. There's these key strategies we can be using around the Fed. Now, that's for swing, and that's what my focus is on. I really talk about day trading. The other guys at Bulls on Wall Street are pros at that, but there's one thing I will mention today, and that's the Fed fade. Basically, whatever the market initially does today at 2 o'clock, and that's when the Fed decision will be coming out at 2 o'clock Eastern, 10 o'clock or 11 o'clock Pacific. When that happens, there's often an initial spike intraday. So if we were to take the intraday action here from yesterday, which didn't move a whole lot, but today, if we were to get a big spike in one direction right away, right at that decision, usually that is going to get faded really quickly. And you can, if you're quick with your trigger finger, you can take a quick day trade. And then after that, things will shake out and we'll get a direction. So pay attention to that for day trades. Now getting back to swing. Oftentimes, whatever happens today, tomorrow, it still takes a few days for actual direction in the market to shake out. So today is Wednesday, watch Thursday, Friday, next Monday. By that time, we'll have a really good indication. So don't make any huge bets in your swing trading today or tomorrow. You can take a few shots here, but really it's quick trading. The next week, once we get the direction, that's when you can start adding bigger and bigger once we know where the market is going. So that's exactly how I'm looking to play the Fed. Put this stuff into practice. If you've never done this before, maybe just watch and paper trade. There'll always be another Fed meeting. But get this VIX trading down around the Fed. This is a really good time to put these strategies into practice. All right, guys, I'll see you next time.